So you are welcome again to our week 3 of corporate reporting. So today we'll continue from where we stopped on conceptual framework. We'll finish it up. Remember last week when we started with conceptual framework, I told you that conceptual framework is the enabler of principle-based reporting. And if you remember what principle-based reporting does, it sets an objective, it sets a target. Just meet it. So we are not going to prescribe to you how you meet it. Just meet that objective in whatever way you can. And that is what IFRS is all about. And what sets objective for us? What sets the target? In fact, the statement of gap itself is the conceptual framework. And we also went ahead to say that is the foundation of reporting itself in such a way that it helps us to now develop new IFRS and amend or update existing IFRS. Then we went ahead to look at what is this objective itself, what is this the content of the conceptual framework. We looked at eight chapters of the content of the conceptual framework. There are 8 chapters, and that is according to the 2018 conceptual framework. We started with the chapter 1 that talks about the objective of a general purpose financial report, and we said the objective is to provide financial information about a reporting entity that is useful to what? Potential and existing investors, lenders, and other creditors to enable them make decision about providing resources to the entity. I told you they won't ask us that in the exam, but they can ask you what is inside. So we explain financial information, we explain the primary users, we also explain their information need. We went on to chapter 2 that talks about the qualitative characteristics of a useful financial report. In there, we looked at the fundamental characteristics and the enhancing characteristics. We paid attention to the fundamental because that's what makes the financial report useful or not useful, which is relevance and faithful representation. We talked about it. I gave you an assignment on it last week. Very handful of you did it. Why? I don't know why you did not do it. Let them see your face. Those that did not do their assignment. Karen, you have not been doing my assignments. You have not been doing my assignments. Stella, you have never done my assignments. I'm calling you guys out. You have to do your assignments, okay? Please do it. So I asked you about telling us the argument for and against the introduction of prudence into the conceptual framework. Those people that did it, excellent point, because it's an open book assignment, so please do it. If you have not done it, you can still do it and send it out. Michael, you did it, right? Yeah. So we discussed all of that, relevance and faithful representation. Then we also discussed the enhancing as well. We discussed the enhancing too. Then we went on to chapter 3 that talks about the financial statement and what? The reporting entity. And that talks about the perspective of a financial statement. And it also explained about, it described the reporting entity and also the boundary of a reporting entity. We learned last week that a reporting entity must be a going concern. If it is not a going concern, it cannot be a reporting entity. So if you set up a business with the aim of liquidating it, maybe after 2 years, you cannot report in line with IFRS. You must not have any intention to what? To liquidate the business. Then we went on to chapter 4 that talks about the element of financial statements. We did not get to chapter 4. Okay, so today we are going to be starting with chapter 4. So chapter 4 of the conceptual framework. Okay, so almost every item in the financial statement is about these elements of financial statements. And there are 5 elements of financial statements. The first is assets. Then we have Then we have liabilities. Then we have what again? We have equity. We have income. And we have what again? And we have expenses. So the first one, which is assets. The way the conceptual framework saw assets, it said an asset is a present economic resources as a result of what? Okay, look at this. So for you to say you have an asset, it has to be what? It has to be present, meaning you must have acquired it first. The second thing is that it must be an economic resources. In fact, that is what an asset is, majorly. An asset is an economic resources. And when we say economic resource, an economic resource majorly is a right that has the potential to generate an economic resource is a right that has the potential to generate economic benefits. So any right you have, and that right will generate benefit to you, that is majorly an economic resource. Just think of anything. In as much as you have right over it, and it will generate resource benefit to you, benefit could be in the form of cash, it could be in the form of reduction of liabilities, increase in assets, like that. What is important is it generates benefit to you. So let's go back to this present economic resource. So when you have this resource, which is something, a right that generates benefit to you, now it now becomes your asset. If you have what? If you have control over it, that is when you can put it in your books as your what? As your asset. Not necessarily when you own it. Not necessarily when you own it. What is important is what? It's control. And it must arise as a result of what? Past events. And that's an asset. There are several examples of an asset that you know already. Several. But what is important is to see an asset beyond those examples and see it as a present economic resource that you have what? Control over. It's very important. Now, liabilities. Liabilities is simply a present obligation to transfer economic resources as a result of what? Past events. So a liability is simply, of course, you must have incurred the liability. It has to be present, and it must be a what? An obligation. And the conceptual framework states that an obligation is a duty or responsibility that an entity has no practical ability to avoid. They can't avoid it. You cannot avoid it. If you can avoid it, then it is not an obligation. An obligation is a responsibility that you have no practical ability to avoid. And what is that thing that you cannot avoid? Is to do what? Transfer economic resources. Okay? So when you have that kind of arrangement where you have to transfer economic resources to another party, then you have a what? A liability. There are a series of examples of that. But you need to know that it is an obligation. Any obligation, something you have to do, and it involves you transferring something, economic resource primarily, then that is a liability. A lot of them, from trade payables to loans to your tax liabilities and all of that. All those are liabilities. Then equity. Equity is a what? Look at it, look at it. Equity is a what? Residual interest in the asset of an entity after doing what? Deducting all its liabilities. So what is important in this definition is this residual interest. You see, there are two sets of people that have an interest in the asset of an entity, and they are the shareholders and the debt holders. Those are the people that have interest in the assets. But you see the debt holders, those one, their interest is preferential in the sense that when we want to pay them their returns in form of finance costs, we pay them first. We pay them as if it's part of our administrative expenses. We pay them first. And also, even if the company should liquidate, we have to settle them first. So debt holders, their interest is preferential. The guys whose interest is residual is the shareholders. So we can simply conclude that equity is synonymous to what? Ordinary shareholders. Is majorly ordinary shareholders or share capital generally. Just that for preference share capital, it is not only equity, because some preference preference share capital, their interest is preferential from their name, in the sense that they get periodic interest, and based on the agreement we have with them, we might have to pay them like as we are paying liabilities. So if you have those type of preference share capital, they are liabilities because their interest is not residual. But there are some preference share capital whose interest is residual, especially the irredeemable preference shares. Irredeemable preference shares are equity. But you see the ones that are redeemable, those ones are what? Debts. They are not equity. You see, at your level, what is important for us is to understand that any contract we enter into, any financial instrument we enter into, and the investor, if the investor's interest is residual, he says, don't give me anything. It's when you make money, I make money. If that is the arrangement, that's equity. And that is what we mean by residual interest in what? In asset, after deducting all liabilities. Now, income. Income and expense. Income is an increase in assets, decrease in liabilities, which results in an increase in equity, other than those relating to contributions from holders of equity claim. You will see that whatever we call income is either an increase in assets. So, and this increase in assets we are talking about here is not acquisition of additional asset too. It's increase as a result of maybe remeasurement or enhancement of that asset that makes the value of your assets go up, right? Is either remeasurement or enhancement of the asset, usage of the asset. now generate something to you. So increase in assets, decrease in liabilities. If your liability should decrease, not because you paid off, but because of another thing. Maybe the person said, don't pay again. If somebody you are owing says, don't pay again, that's an income. Or maybe as a result of measurements, maybe, right? So if your liability should decrease, is an income. And you see, increase in assets, decrease in liabilities can result in what? Increase in equity. But generally, there are two things that can increase your equity. There are two things. Do you know them? Do you know them? Stella, you want to try? Yes. What can increase your equity? Yes. Additional capital. If you bring in more capital, that can increase your equity. But is additional capital income? No, that's not income. So that is not the increase in equity we are talking about here. That's why they said, other than those relating to contributions from holders of equity claim. Contributions of holders of equity claim is additional capital. So that's not what we are talking about here. So what are we talking about here? Profits, all written earnings. Yeah, profit majorly. Profit. Okay, so profit is an income, and that's it. And you will see a lot of examples of incomes in this class. But before I move on, can anybody distinguish between revenue and income? Last day, they asked a lot of questions on IFRS 15 on revenue from contract to customers. Can anybody distinguish between revenue and income? Who wants to try? Revenue and income. Okay. Oh yeah, I'm listening to you.
Revenue is more or less like income. Revenue is more or less like sales. Yeah. Why income is more or less like the difference between your revenue and your expenses. That gives you
Okay,
income.
okay. That's not a bad trial. Victor, you wanted to say something? That's not a bad trial, though it's wrong, right?
Okay, so I want my own
Hold it,
way.
hold it.
Okay, in my own distinction, I would have said that revenue is an income from primary business, while income is from all sources.
Okay, I think I will agree with Victor on this. Victor said revenue is what you get from your sales, yeah? Your proceeds from your operations, right? So revenue is the gross inflow of cash or other benefit from your primary line of operation. That's revenue from your primary line of operation. Why income is revenue plus other sources. Revenue plus other sources. It's just like saying revenue plus other income. It's just like maybe in your business now, you are running a business and you purchase from a supplier, the guy gave you discounts. That discount received is not revenue, but it's other income. Abi? Right. Or maybe you have some surplus assets that you are not using and you now decided to sell it. You know, the money you get from the sales is not the income, but the income is when you deduct the cost from the sales. That gain you get is income. That's an income because that's not your primary line of operation. Something like that, right? Or maybe now that there is naira devaluation, you get some gain on foreign exchange. That is an income. Or maybe you revalued your property. That's other income. Or maybe you revalued your property. You now have evaluation surplus. Those are other income. So income is bigger than revenue. Income is revenue plus other income. So it's huge. In fact, the best explanation I've had was this is an exam. This was one of our colleagues that mark script, right? So he was trying to explain the distinction, right? And this person has the best caption. He said, revenue, give an example. Maybe that's, I don't know. He gave an example that if you sell air on Instagram, and that's your primary line of business, sell air on Instagram, that the money you get from selling that air is revenue. is revenue. But if I don't even know how to say this, because she wrote it down. She said if you now do hookup, that one is other income. Ah, I think the guy snapped and showed me. You see, I've not seen a better caption. She captured it better. If you now do that one is other income. Then the do together is your total income. But you see, even though it's funny, but she's very correct. She has expressed it so perfectly. Okay, now the last one is expense. Forget about it. Forget. Move on. Move on. Move on. Okay, if you look at expense, this is just like the reverse of income. So expense is a decrease in assets. If your asset decreases, that's an expense. It's an increase in liabilities. If your liability increases, that is an expense. You see, decrease in assets, um, increase in liabilities will result in what? Decrease in equity. And fundamentally, there are two things that can decrease your equity. Two things. One is dividend. Yeah, when you pay dividend to shareholders, it decreases your equity. But is dividend an expense? No, dividend is not an expense. Dividend is not an expense. It's an appropriation of profit. It's a share of profit. You don't find it in the P&L. You find it in the statement of changes in equity. Okay, so that's why this guy said that this decrease in equity is other than those relating to distribution to holders of equity claim. Distributions to holders of equity claim is dividend. It's dividend, that's the distribution we give to them. Is not an expense. That is not the decrease in equity we are talking about here. So what decrease in equity are we talking about here? Losses, right? When I taught this in another class, a student asked me, what about drawings? Drawings, can it result in decrease in equity? I said yes, but that would be prevalent in a sole proprietorship business or a partnership business, right? Decreases their equity. Yeah, it is not. So that's like distributions to holders of equity claim also. It is not expense, right? So for companies, you cannot withdraw. You cannot say you want to draw. In fact, it's against CAMA 2020. You are not allowed to reduce your share capital. You cannot with this. It completely frowns on reduction of capital. That's why what happens in publicly quoted entities, I think Dangote did that some years ago, I think last year, where he wants to increase his holding in his company. He cannot go to CSA and reduce share capital. What he can do is to buy it back from existing holders. Just transfer of ownership. Okay? All right. And that's expenses. And that's it for elements of financial statement. Almost everything we do in reporting is this. Though at corporate reporting, we go, of course, ahead of this. Now, the next one is recognition and derecognition, which is on chapter 5. Recognition and what? Derecognition. Now, this one wants to show us recognition first. Recognition talks about the process of capturing for inclusion. Is what? The process of capturing transactions for inclusion into the financial statements. That's synonymous to recording, right? What we call recording, that's exactly what we mean by recognition. Okay? But even they might not ask you that definition in the exam, but I think you need to know what are the recognition criteria before you can include an item or elements. These are the elements you include. What are the criteria they must meet? The conceptual framework says that the item must be what? Must be relevant. Must be capable of making a difference in the decision. It must have predictive value and confirmatory value. If it does not have that, then you cannot include it. Another thing is that it must be faithfully represented. Faithful representation. Faithful representation. These are the two recognition criteria. So now recognition criteria, according to the 2018 conceptual framework, is now in line with the fundamental characteristics. Thus, it has to meet those two before you can recognize an item into the financial statement. Now, let's go to the recognition. If recognition is inclusion, so what would the recognition be? Exactly. Yeah, that's correct. It's the process of removing an element from the financial statements, right? So, what are the criteria? Before you can remove an item, what are the criteria? Yeah, there must be loss of control of an asset. And two, there will be settlement of what? When you settle our liabilities, then you probably would derecognize that liability. You will see that derecognition was looked at from the angle of assets and what? Liability. Because as soon as you remove your asset from your books, you won't generate any income again. There's no more income. If you remove your liabilities from your book, there is no more expense. You won't get any expenses again. And again, the aggregation of asset minus liability gives us what? Equity. So this two is the main thing. When you remove them, there's nothing again. So what we are saying is this. Loss of control of an asset. Remember, what makes you even recognize an asset in the first place is because you have what? So if you lose that control, just remove it. And liability, when that obligation is not there anymore, you have settled it out. You have transferred economic resource, remove it. And those are the two derecognition criteria. Any questions? Let's go to chapter 6. Reporting is about money, majorly. Reporting is about money. So the process of attaching monetary value to elements that are recognized in the financial statement is measurement. Abi? So what you need to know is, okay, what's the basis of this measurement? How do we measure? What's the basis of measurement? There are majorly two bases of measurement. What are they? Where are my FR students? Initial measurement, Bawo. What do you say? At what? At cost. And don't just call it cost in the exam, please. You call it what? Okay? Because if you say cost, it could be something else. It could be current cost. Okay? The first basis of measurement is historical cost. And the second one is what? Current value. These are the two measurement bases we have in reporting. Historical costs and what? And current value. And historical cost is the amount at which you bought an asset or the amount at which a liability was originated. Right? That's by definition the amount at which you bought it, the amount at which you originate a liability. That is an historical cost. But by explanation is that If you bought a motor vehicle, let's say in 2015 for, let's say 1.5 million in 2015, and in 2023, which is now, it will still be at 1.5 million. That's historical cost. So you will still be maintaining that cost all through the useful life of the assets, right? So now the 2018 conceptual framework added more flexibility to this because it noted that using historical cost will make the financial report irrelevant over time, right? Because by the time you say you bought something 1.5 and you are still putting it in your books at that, it will not be relevant. So he said that we should note that using historical cost, that this historical cost might diminish in value as a result of usage. It might diminish in value as a result of what? Usage. How do we do that in reporting? Depreciation. Depreciation. Yeah. So he acknowledges the fact that you can depreciate those assets as you use it. Another one, he also mentioned that as you also use the assets or as time goes by, you might not be able to recover the value of that asset. Because in reporting, when you have carrying amount as 10 million, the assumption is that you recover 10 million over time. But now he's saying that, yeah, if you're using historical cost, there's a possibility that you might not recover that amount. How do we show that in reporting? Impairment. This girl is hot. That's impairment, right? So you use impairment to show that. We are going to be doing that. We are still going to consider impairment again very soon. So you will see how we account for all of those items. What I'm not really going to sit down and start teaching you again here is depreciation. I will not start teaching you depreciation, but it's important for your exam. It's important for your exam. Of course, if you go to our page, you will see the lectures I will have recorded for PPE. You can use that to revise depreciation because they can ask you, it's assumed you know it, but we are not required to teach you again here. So you need to, but we'll teach you impairment here because there are some advanced parts of impairment that we'll still have to look at this level here. Okay, and that's historical cost. The next one is current value. The current value also is the amount at which an asset is acquired or liability originated. But the difference is that current value is updated based on changes in economic circumstances. Current value is what? Updated based on changes in economic circumstances. So that's what makes current value different. We update it. So by the time you have current value in your books, it will show what is happening now, unlike historical cost. So consistently is updated, continually is updated. Now, the circumstance of an asset depends on three things, right? One thing is this: the circumstance might be you want to sell the asset. That could be the case, that you want to sell it. If your intention is now to sell the asset, then that will inform what the current value will be, right? So if you want to sell an asset, what do you think the fair value should be? I've said it. That will be the what? The current value will be the fair value if you want to sell an asset. So fair value is something we'll be doing in, I think, week 8 or thereabout. IFRS 13. We'll look at how to determine fair value. There was a time they asked it back to back. Now they have cooled off a bit. We don't know if they are going to come back to it. But fair value is one of the current value bases. Okay? Fair value. The second one is that your plan might be that you want to use this asset, you want to continue to use it for a specified period of time. And after that period, you sell it. You want to use it for a specified period of time, and after that period, you sell it. In that case, if you want to show that, what will be the current value? Value what? No, it's not carrying amount. Value in use. Value in use. Okay? We're still going to look at this again, but the intent of using this is what I want you to learn today, not the calculation, but we are still going to look at that. The intent of this is when your intention is to continue to use an asset for a specified period of time and sell it eventually, okay, then the current value you use there is what? Value in use. Then finally, the third one is that you might want to replace an asset in its present condition. Okay, if you now want to replace, if you want to replace an asset, the relevant current value is going to be what? Okay, that will be the current cost of the asset, which is similar to what? Which is similar to replacement cost. Okay, so this is current value, and these are the measurement bases according to chapter 6. Any question on this? Okay, so let's go to chapter 7. Okay, so chapter 7 talks about presentation and disclosure. Abi? So all these elements we have discussed in chapter 4 and their measurements we looked at in chapter 5, in chapter 6 here, we have to present them somewhere. They have to be properly presented. And also, not just presenting alone, if you need to give user more information, then you need to do some disclosures as well. Then what this majorly is talking about is those presentation. How do you present it? And the elements we discussed, there are 5. First, he said income and expenses should be presented. Where do we present income and expenses? Statement of profit or what? Majorly, this captures income and what? Income and expenses. Where do we present assets and liabilities? So, statement of financial position. This will capture your assets, liabilities, and what? And equity. Also, when there is remeasurement of assets or liabilities, or where there is changes in the value of assets or liabilities, that change or that gain you get from remeasurement, where do we put it? You put it in the other comprehensive income. This majorly deals with remeasurement or changes in value of your assets or your what? Or liabilities. That's what goes to your other comprehensive income. And finally, it talks about recycling. It talks about recycling. And what this means is that you should transfer realized gains from OCI to where? To statement of profit or loss. Transfer realized gains from OCI to statement of profit or loss. Now, you see, we have P&L, we have other comprehensive income. You see, those two captures income. The difference is that the income and expenses that goes to P&L are realized. The ones that goes to OCI are unrealized, like revaluation surplus. If you revalue an asset now, that is an unrealized gain. You don't want to put that kind of gain in P&L because it is not readily available to distribute to shareholders. It's not something you can show that I've earned this profit. No. So they suspend it in OCI, pending when it is what? Realized. Another example I think you might relate with is that with this naira devaluation, if you owed $1,000 last year at 500 naira per dollars, that's you'll be having in your books in naira like 500,000 naira. Abi, if you are still holding that $1,000 till now, let's say it's even 800 naira, that would be like 800,000. You'll have made a gain of how much? 300. That's a typical unrealized gain, right? Though, which I might teach you in this class, IS 21. IS 21 says that gains that you make from foreign exchange is realized because it's cash. It might not be in our reporting currency here or in naira here, but it's money, it's cash. So we don't call foreign exchange gain unrealized. So it doesn't go to OCI. Foreign exchange gain goes to where? P or L directly because it's cash. It's earned. It's money. Okay, so that is it for chapter 7. Finally, is chapter 8. Hola. Hola. How are you? How are you? I'm coming. Hmm? No problem. No problem. Yeah. Are they empty? Chile, show me come on the laser. Think you want baby? Okay. So where that disclosure comes in is that, of course, you might need to present further breakdown of these expenses and assets, or need to provide further information to the users. Then that is where disclosure will actually what? Will come in. So finally, let's go to chapter 8. And this talks about what? The concept of capital and what? Okay, let's start with the concept of capital. Then we'll go to capital maintenance. Because these are two items. There's a concept of capital and there's capital maintenance. So first is the concept of capital. See, what the conceptual framework is saying here is this. It just wants to prescribe how we determine our capital. It just wants to define capital. What is the concept of capital itself? Though we know capital as the money we introduce into the business to run the business. But as a financial reporter or corporate reporter, how do we define that capital? What is that capital itself? So it looks at it from two sides. It looks at it from two sides. The first one is what? Is the financial concept of what? Is the financial concept of capital. And the second one is what? The second one is the physical concept of capital. Now, the financial, this is capital. The way it defines capital is majorly asset minus what? Is majorly asset minus liabilities. And this is what we use in reporting to today. The way we determine our capital is dependent on the value of assets and the value of what? Liability. It's just the monetary value of that capital after considering our asset and liabilities. That is your capital. That's the financial concept of capital. Assets minus what? Liabilities, right? But for the physical concept, this one, no, we don't use this in reporting because this one looks at capital as the productive capacity or the operational capability of the capital. It looks at capital from being productive capacity or operational capability of that capital. What does that mean? It means that we are looking at capital as what the money can buy. What is your productive capacity? It's just like you're selling shoes, for example, now, and your money capital is 100 million, right? Your physical capital is what is the value? What quantity can that 100 million get you? So we receive physical capital, not the money, but what you have stocked your warehouse with. What you want to that's how this guy sees your capital. When they want to value your capital, they will just say, what do you sell? Let's see your warehouse. What they see, what you want to sell, that is your capital. And that makes sense. Because it's only when you sell those things that you can actually breathe as a business. If you don't sell them, you might be out of business. So it sees your capital as your productive capacity or your operational capability. So there's a huge distinction between the two. One is looking at money, financial concept of capital, while the other one is looking at units of output, productive capacity. That's the concept of capital. Then the next one is capital maintenance. Capital maintenance, meaning that it is important that you maintain this capital. You have to maintain it. And how do you know that you have maintained capital? It depends on the concept of capital you're using. It depends on the concept of capital you are using. So if you are using a financial concept of capital, then how have you maintained your capital? We call that financial capital maintenance. We call that financial capital maintenance. And what is financial capital maintenance? I'll explain that with an example. So if at 1st January 2023, your money capital was 100 million at the beginning of the year, and at the end of the year, your money capital is now 120 million. So by implication, your capital has increased by how much? 20 million. So you have this school of thought to say that you have maintained your capital, which is what we have today. Because you have maintained your capital, if your capital at the end, your money capital is higher than your capital at the beginning, then you have maintained your capital. This 20 million, what do we call it? Profit. Thank you. That's my girl. So now you see this profit. So we can say that you have financially maintained your capital if you make profit. We can summarize it like that. So whenever an entity makes profit, it has financially maintained its what? Its capital. And that is what we do today. You see, when a company makes profit in its P&L, it increases its capital. It increases its capital. But on the other hand, the physical side, which is the physical capital maintenance, let's look at this one. Let's say the money capital you have, let's use the same example, was 100 million at the beginning and 120 million at the end, giving you 20 million profit. This guy does not look at this one. He doesn't recognize this one. But he asks the question, how many units can this 100 million give you? How many units? So let's assume this guy sells car. And to produce each unit of car, let's say it's 10 million. Assumption. Let's say it's 10 million. So per unit is how much? Is 10 million. If one unit is 10 million and you have 100 million capital, how much would this have given you at the beginning? How many units? It will have given you 10 units. At the end of the year, if this company is in Nigeria, do you think it will still be able to produce one unit at 10 million after 1 year? No, it's not possible. Inflation. What will have, how much? Just guess. What do you think you will have been able to? How much? Kilo day now. We are 10 million at the beginning. Like 17. Right? You are saying maybe 30 million. Is that what you're saying? Uh-huh. It will have increased. It will have increased. Your production cost per unit will have increased. So it can even be 50 million now. Sir. Okay. So let's even say 20 million. Let's say 20 million. So now, if you are not producing one unit at 20 million at the end, so how many units can you now do? Can do 6 cars. Abi? Has he maintained his capital? No. So physical will say that you have not maintained your capital because you have not maintained your productive capacity. Your productive capacity is 10 units at the beginning of the year, and at the end of the year is how many units? 6. You have not maintained your capital. You see, this analysis might be one of the reasons why most business or some businesses will fail because this is what we use in reporting. Most businesses, by the time they see that we have made a profit of 20 million, no, let's share. So they will start sharing money, pay dividend, and all of that. But you as professionals, right? You as professionals should not allow that. In fact, what you should tell them is that, see, yes, reporting wise, we have reported a profit of how much? 20 million. But reality wise, we will need to inject 80 million for us to be in the position we were at the beginning of the year. Otherwise, we'll be out of business. Okay, don't share any money. Don't share money. In fact, you have to inject 80 million. Look at it now. For you to produce additional 4 units at 20 million per unit, that's 80 million. So you need to inject additional 80 to make this 120 million how much? 200 million. Okay, so this is more realistic. And majorly because it's considering inflation. This has considered inflation. The only reason why we are not reporting in this manner, capturing inflation in all our expenses, because it will make the financial report complex, might not be simple and concise, which is not in accordance with the enhancing characteristics of financial reports. One of the tests I will give you next week is that I will give you like a small scenario where they will give you expense, sales, and inflation. And I'll ask you to compute profits using physical concept of capital and financial concept of capital. It's a past question. So go and look at all the past questions they have asked from now till like 2015. You'll see it there. If you don't have time to see it, you'll probably be solving it in class next week. Okay, so that is it for conceptual framework. Thank you.